Don't confuse cash with income. It's only income if you get to keep it. There are so many misconceptions about covered calls and how to properly employ a covered call strategy. I run into people all the time who are costing themselves money by either not setting up covered calls correctly, or they're managing the trades wrong, or both. Hopefully, in this video, we can help you determine the covered call approach that works best for you. I'm going to start with a simple overview of what a covered call is, then lay some basic ground rules for covered call trading. After that, I'm going to explain proper management techniques for a traditional covered call approach, and in the process, hopefully clear up some misconceptions that many traders have. If you're already familiar with covered calls and you don't think a review is going to do you any good, you may want to skip ahead a bit in the video to where I talk about the mistakes, and the common mistakes especially, and proper management. Either way, don't forget to like and subscribe. The main purpose of a traditional covered call trade is to create income while also having opportunity for growth. The first step in owning a covered call is stock ownership. In order to place a covered call trade, you need to own at least 100 shares of stock. Well, you can do this on stock you already own, or you can buy the stock as part of the strategy. It's called a buy right. Now, if you own 100 shares of the stock, you can then sell a call option against that stock. But when you sell a standard call option, you're entering into a contract. It obligates you to sell 100 shares of stock at a predetermined price, known as the strike price of the option. Well, the traditional covered call approach is to sell an option that is out of the money. Well, let's go through a basic example. Suppose you own 100 shares of stock worth $50 per share. To create a covered call trade, you'd sell a 55 strike call that expires in 1 month. Well, somebody's going to pay you for selling that call to them. Well, let's say they give you $1 per share for it. Now you own stock that's worth $50 and you've agreed to sell it to someone else for $55. In return for agreeing to that, you received a premium of $1 per share. In an ideal world, the stock will go up just a little bit, say to $54 in the next month. If that happens, you'll have a $4 profit on the stock, and the option is out of the money and expires worthless. If the option expires worthless, you get to keep the dollar you sold it for, and you get to keep your stock. You repeat the process the following month by selling a higher strike call. Then you do it again the next month, and then the next month, and then the next month after that, and so on forever. Of course, that would be an ideal world, but we don't live in an ideal world, so let's talk about a couple of real-world scenarios. I often ask people, what is the worst-case scenario in a covered call trade? And almost every time I get the same answer. It's something along the lines of, well, if the stock goes up too fast, then I'm going to get called out. That is the wrong answer. It's true that in a covered call trade, you can get your stock called away, but that's not necessarily a bad thing, and it's definitely not the worst case scenario. In our scenario, you paid $50 for the stock, and you received a $1 credit. If you get called out for $55 and you get a credit of $1, you still made $6 per share, didn't you? The stock going up faster than you expect is not the worst case scenario. In fact, it's a good thing from a profit and loss perspective because it means your position was more valuable at the end of the trade than when you first put it on. In other words, you made money, and that's not a bad thing. Now, there may be some opportunity cost if the stock really takes off, right? But hey, you still made money. In reality, the worst thing that could happen in a covered call trade would be if the stock crashed. Well, think about our scenario we just went through. You spent $5,000 on the stock and you sold the call for $100. Which part of that trade do you think matters more? Remember, your primary motivation in this trade is the stock you own, not the call you're selling. If the stock crashes, you could lose a lot more money than any risk from the call. Now that I've covered an overview of a traditional covered call, I also want to set some basic guidelines, and these guidelines apply no matter what approach you plan on taking with covered calls. Rule number 1, do not sell calls against stock that you're not comfortable selling. You can't have it both ways. If you sell a call, you are entering a legally binding contract that obligates you to sell your stock. There are ways to tell if a call option is likely to be exercised or not, and I will cover that briefly. But the reality is that it can be exercised at any time, and you have to be prepared for that. Rule number 2, the stock is the primary driver in the trade, not the call option. Think about where the most risk is in the trade. It's in the stock. You need to have pre-established rules for when you're going to get out of a losing stock trade before getting in. Rule number 3, the call you are selling is there to provide income. It is not a hedge. Stop calling covered calls a hedging strategy. It's not. Selling calls is not going to bring in enough money to offset a stock that's in a free fall. A $1 credit like our example had is not going to significantly offset a $10 or $20 drop in the stock price. Covered calls are not a hedge. Rule number 4, be forward-looking, not backward. Well, this actually applies to all trades, not just covered calls, but I see it most often on covered call trades. And what I mean by that is that sometimes someone will come to me and they'll be way upside down on the stock. They're losing money. They're losing $50, $60, $70 a share or more, and they want to sell covered calls on it to try and create income, lower their cost basis, while hopefully it goes back up. Then if the stock goes past their covered call and they get called out, they're devastated because it means they took a loss. Well, guess what? That money was already lost. Just because you haven't realized a loss doesn't mean your portfolio isn't down. And sometimes the best thing you can do is ditch the loser and put that money somewhere better. Be focused on making money going forward, not fixing past or current losers. Rule number 5, if you want to buy the call back because you don't want the stock to get called away from you, you do it when most of the extrinsic value is gone. This is actually a really simple rule that way too many traders just don't understand, and it costs them money. Let me show you a real-world example of what I mean. Well, let's pretend that we sold a call on this stock. We sold the 95 strike call for $1. The stock's above $95 now, and so the call option is in the money. Well, this is where I see so many traders make their biggest mistakes. They panic. They buy the call back because they're afraid of getting called out, or they're afraid they're going to lose more money on the call. Well, first of all, if you're that afraid of getting called out, you shouldn't be doing covered calls anyway. See rule number 1. But this call option is not really in much danger of being exercised right now anyway, and we're still in a spot to make money on it. Remember, the call option gives the buyer the right to purchase the stock for $95 per share. If the person who bought that call from you exercised their rights today, that would make them $1.50 on the stock. But in order to do that, they'd have to give up their option that's worth $2.55 per share. So if they exercise the option, they'd actually be costing themselves money. This option still has over $1 of extrinsic value remaining. The next objection I get in this scenario is, but I'll keep losing money on the call if the stock keeps going up. Oh, that's true, you will. But first of all, how do you know for sure the stock is going to keep going up? Do you have a crystal ball that tells you the future? Second of all, even if the stock does go up, you're making more money on the stock than anything you're losing on the call. The option has a delta of 0.64. So if the stock goes up $1, you're going to lose 64 cents per share. But you're going to make $1 per share on the stock, so you'll still be profitable overall. And how silly would you feel if you bought that call back at a loss, and over the next week the stock dropped to $90? Now you lost money on the call and the stock. The truth is, we don't know for sure which way the stock is going to go. But we do know that time is going to keep going by. The call we sold makes us money on time decay. So how do you know when it's time to buy the call back? You buy it back when most of the extrinsic value is gone, because that's when there's no time decay left to profit on. It's a very simple rule. Just buy the option back when most of the extrinsic value is gone. Now, of course, if you don't care whether the stock gets called away from you or not, you're fine to just let the call expire. If it's out of the money at expiration, it'll expire worthless. You'll get to keep the stock and your credit. If the option's in the money, you'll get paid cash for your stock and you keep your credit. Next, how do you pick which option you're going to sell? Well, this is an important one. There are many ways to approach covered calls. You could do short-term, out-of-the-money calls for income and growth. Now, that's the traditional approach to covered calls. You could also do short-term, in-the-money calls purely for income. Or you could do long-term, out-of-the-money calls for stability. Now, I'm not going to go into the details of all of these in this video, but it is important that you understand at least the differences in long-term versus short-term option selling. I see investors sell covered calls that don't expire for a year or longer because of the amount of credit that they bring in. Well, that approach can work if what you are looking for is something that will provide a larger offset if the stock goes against you and increase stability in your portfolio. But if you're trying to create income, it's one of the worst mistakes you could make. Let's use the same stock we were looking at before as an example. I could sell a call that expires in 42 days with a delta of somewhere close to 25. Now, this means it's going to be a little bit out of the money and it'll give the stock some room to run up. In this example, it would bring in a credit of $1.43 at the bid price. If I sell an equivalent delta call that expires about 500 days out, I'm bringing in $4.55, and I'm also giving the stock a bit more room to the upside. But how quickly am I collecting that income? The call with the longer expiration has a theta of 0.0173, which means I'm collecting about 1 3/4 cents per day in income right now. The shorter duration call has a theta of 0.0578, so I'm actually creating income more than 3 times faster with the shorter dated option. I could repeat this process every month or so and end up with far more profit overall than going out further in time for a higher upfront credit. Don't confuse cash with income. It's only income if you get to keep it. And shorter term options, because they decay so much faster, let you keep that time premium faster. As with any strategy, we always encourage you to paper trade. Find an approach that works for you. Remember the tips I've suggested. And if you have an approach to this strategy that you prefer, I'd love to hear it in the comments below.